You just told me I'm going. You said you ready.
Hold up,
You
hold up.
ready. You ready.
You better stop
They,
that.
they got a few men to come in. What you mean? They got a few minutes to come in. You look fine. Got
Take
you
it.
looking.
Start it over.
I can't. Then they're going to change everything. Why you look? You ain't ready? We got one first. Thank you, Kenneth Trueblood, for being first. Hey, how you doing tonight? Thank you for joining me in the lovely Shateka. Look at us. You all fly over there. I should know. I should have got dressing up, you know? So listen, we're gonna get straight to it. We're not gonna be long, but we're gonna be
Y'all see
strong.
how he do me? He goes live when okay.
Look,
All
you
right.
ready.
I thought I was too. Until I
You
just
ready.
dropped my hair down and then I was about to put it back up.
No, you look fine. You look fine. Go ahead.
You go ahead.
So here it is right now, everybody. Thank you for joining us. We're live and based right now with Shateka. Take it away.
Take it away. Take it away. I like the way you say that. Who do we have here? Talk of the State TV, Kenneth Trueblood. All right. Well, for the replay viewers, hopefully we can crop out the first part, like before we put it on here. I'm Shateka, CEO of Husser Financial Solutions, where we help you retire before you expire. So if that is you, we're the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. You guys know I talk about that all the time because I'm in a fight to end retirement poverty, because it is such a thing where people do not have what they need in retirement because they haven't properly positioned their money. And so we talk about different things and on this segment. And one of the things that we're going to talk about tonight is the differences between annuities and life insurance and why people actually choose annuities over life insurance. So let's just say this, right? A lot of people don't really know what annuities are, but it's primarily what you're doing with your Social Security. So you're basically buying your income in the future at where you are right today, right? So you're setting aside money to be able to allow your money to grow over time so that when you need it, it's there, but it's continuing to grow. Kind of like what you guys are already doing. Some people say, well, I need to invest my money. I know I got to get my money working for me, but you don't really know how to invest your money. 9 times out of 10, people don't know how to invest. And it's because they just haven't been trained, right? Or they might go in and try to learn and then they burn some of their money learning, unfortunately, instead of using demo accounts, which is what I would encourage everybody to do. If you're trying to learn how to trade or, you're trying to invest, you need those types of, activities. You want to make sure that you use a demo account first before you do a live account with your real money. But a lot of people are trying to make something happen. And sometimes they get taken for scams. I have one of my family members getting scammed all the time. But one thing you can rest assured that you will not get scammed in is if you have an insurance product or if you have an annuity product, right? They're two in the same because an insurance carrier is the one that houses them both, right? So they do both annuities and what we call life insurance. So I know that, people don't really understand what the differences are, some, right? So let me talk about that. So annuities is going to be, let's say you went and you try to get an insurance, policy and you can't because of your health, right? That is the number one thing that people go to aside from insurance is going to be an annuity because you don't have to have the health component whenever you're trying to, put aside this money and have it as a legacy, right? So there's a couple of different types of annuities that are out there. The one that people often hear about, they might hear this terminology, annuitize. You don't want to hear that terminology. So annuities have gotten a bad name because of the word annuitize. Okay, when we say annuitize, we mean that you're putting your money away inside of this annuity, also known as an IRA. You can use them simultaneously, right? Or synonymously, I should say. People know about IRA, but they don't know what annuity is. Annuity is an IRA. It's an individual retirement account. It's something that you could put away, and it's governed by the government, just like an IRA is, right? And the long story made short, you can have a Roth annuity or a Roth IRA, meaning that it's tax-free, or you can have just a normal IRA or normal annuity, and it's tax deferred, just like the 401k. of course, eventually it's going to be taxed, right? If you don't pay the taxes already, right? So the goal is to try to move it into a Roth annuity, to a Roth IRA, so that you don't have to worry about taxes later on. But if you can't, the goal is to still have something accumulated for you. Well, there's some annuities out here that's doing phenomenally in comparison to an insurance. If you want them for real growth, some people want real growth, they go to an annuity more so than an insurance, because of some of the ways that they actually put the money, the ways that they fund it or they invest it a little differently, right? So primarily in like stocks and things of that nature. Like, for example, we have some that are doing what's called 210% or 200% of participation rate. You got to understand what a participation rate is to understand that. But participation meaning that if the market is doing 10%, right? That participation rate is 100% of that, or is 210% of that 10% that the market did. I hope that makes sense to people. So if you're making 10%, what's 100% of 10%? That's your participation rate. So you have carriers out here that's doing way less than that. You have some that's doing way more than that. You just got to know what the participation rate is in the market. So again, if it's 10% and the market and they're doing 100% participation rate, that means you get 100% of 10% that the market made. If they're doing 210%, then that's different, right? So that's 10% times 210%, not necessarily just the 10% itself at 100% rate. That makes sense, because there are some that are less than 100% participation rate. And so you don't even make as much as the market is making. So what's attractive about an annuity is that you can literally jump into certain ones depending on your age, and a lot of different criteria will determine which ones you're going to be eligible for. The older people have a greater advantage with an annuity because of the 210 participation rate and the 200 and just the regular 200%, participation rates that they allow on those age, because they know that you're trying to play catch up with your account and your retirement. So the goal is to understand, number one, if you have an annuity, one of the reasons people go for annuities more so than a life insurance policy is because they like the bonuses that annuities give them. Annuities are, different companies are doing anywhere from 4 to 12%, depending on which state you're in, will determine what percentage of bonuses you can actually receive. You know what I mean? So let's say if you have $300,000, and you often hear this terminology, rollover. You cannot roll over any type of employer plan or pension plan into a life insurance product without paying taxes, right? Without being penalized. But you can roll it into an annuity and not be penalized, because it's also a government regulated, financial vehicle. So people are rolling over. So for example, their 401k or their TSP or an IRA into an annuity because they want the bonus. So they get a little jump on their money, right? And in addition to that, they get all this growth, especially if they're, one that qualified for that high participation rate. Okay, so Shateka, so what does it come with? What kind of benefits? I know that IUL, it comes with, all these different benefits, right? Protection from everything, and then all the medical benefits, and then you get a death benefit. Well, the annuity comes with, depending on which ones you have, right? It'll have a terminal illness component, and it'll also have a well-being rider. So riders are types of benefits. You have all different types of riders that you can attach to any type of policy. But for the purpose of annuities, the one that comes with that is going to be the well-being rider, meaning that if you cannot use two of your your daily activities, then you will be able to access that double time, right? Like basically whatever the funds are that you're receiving, you can double that for 5 years. As long as there's, some type of challenge with you medically where you're not able to use two of your daily activity functions, right? In other words, you can't walk, you can't bathe yourself, you can't talk, things of that nature, right? So those are what we call activities of daily living. If you can't use two of those, then it's doubled in terms of whatever it is that you're going to receive from an income perspective, because you could turn it on as an income like you can in Social Security. And now it doubles whenever you have those challenges. But otherwise, you're just going to receive that. Now, Shateka, I want to take out withdrawals. How does that work when it comes to an annuity? You could take out 10% penalty free every year on whatever your annuity is. So you can create yourself an income. Say you have $200,000 in there, then that's $20,000 that you can take out every year until that money is depleted. If you would like to do that, a lot of people want to use their money for something. Now that's 10% penalty free. However, you can still take out more. It'll just be the penalty based on what's written inside the contract. See, the annuity is a contract, and you can negotiate all that and talk about all that before you even get into that, just like you could anything else. So it's a contract, and in that contract, you'll be able to see exactly what the penalties will be based on whether you go above that annual 10% penalty-free withdrawal that you have on your annuity amount. So I know I said a lot. I want to see, I want to pause here to see if there's any questions, and let's continue to talk about the annuity a little bit more because there's still a lot that we can cover. One of the things I want to talk about, though, is that a lot of people hear about that terminology, annuitize, and the reason why the annuity have a bad name, and I'll just say that, because if you talk to somebody, they may say they don't like annuities because they probably have the wrong type. So there's a couple of different types, right? But let's just talk about the fixed index annuity, or maybe the index annuity. As long as it has index in the name, remember that we talked about that several times. As long as it's index in the name, it cannot lose a penny. Okay, it'll be in a contract. You can see the contract. You can read it. You can say, show me where it says that at. It'll tell you that there's not going to be any loss, right? And you'll know that by the illustration because it won't lose any money, right? All right. So an index annuity is what we're talking about. Anytime I'm talking to you about a insurance or an annuity, you best believe I'm talking about an index, because my goal is to help people not lose their money. Okay. So this like the wealthy, and it's like, go ahead. You have a question?
Why
I don't want to lose my thought.
Why is index so important?
Because index, that's what I was getting to. Index is not going to allow you to lose any money.
Mm-hmm.
So it's going to allow you to participate in the market when the market goes up. It's not going to participate in the market when the market goes down. So think about steps. And if I had a board, I could draw you a steps, right? Well, you're going up the steps. And okay, this is just like when the market is going up, you're going up, okay? Now let's say the market goes down, but you're on a step of an annuity or any type of index product, right? And you're going to the next level. Mm-hmm. Well, when the market goes down, only thing you do is you freeze at that next step. So let's say you went up to, 10% and you have $200,000 in there and the market tanks. Well, you're going to keep that $200,000 in there. Everybody else is going to be losing their shirt in their mind. You're going to be sleeping at night because you are rest assured that you're going to stay on that same step and you'll never lose any money. Okay. But when the market goes up, you go up to the next step. Okay. Your money grows. Now you done add another 5% because it went up 5%. To $205,000. It's going up to the next, it can only go up. When the market tanks, it will only just freeze where it's at on that step. It'll freeze, okay? It will never go down. So that's the reason why you like index products. You love index products because Warren Buffett says that, you have to understand rule number 1 is to never lose money. And rule number 2 is to go back to rule number 1 and remember to never lose money. And so that is why the wealthy, the billionaire wants an index product, and they are going to have an index product. That is why we talked about Bowley and Coley last week. We talked about bank-owned life insurance and corporate-owned life insurance, BOLI and COLI. That's how they go from, millions to billions to trillions, because they have life insurance and they build wealth in those life insurance policies because nobody knows how to invest as good as an insurance carrier. You best believe if a bank is doing it, you need to be doing it. If you're somebody that's trading and if you know anything about trading, and I used to trade Forex, we used to always say do what the bank is doing. The bank is trading on a 4-hour time frame. So you can trade on a 4-hour time frame, depending on who you talk to. Because somebody else recently said, no, they scalp, but not so. But because the biggest moves in a trade is going to be on a 4-hour time frame and higher. So you want to do what the banks are doing. You want to play like the bank. Do what the bank do. You know what I mean? When in Rome, do like Romans do. So the bank is going to be putting their money in a life insurance policy because they want their money to grow. Okay, FDIC insure is $250,000 in a bank. A life insurance carrier could do a whole lot more than $250,000. Okay, they insure it. And how do you know that, Shateka? Because you can go to your state's insurance commissioner. And they're going to be in big trouble if they can't do what they told you they're going to do in terms of their contract. They will be out of business, okay? And so no insurance carrier is going to do that. They would rather drop you and not even carry you than to bring you on and be a liability for them to carry. That's why I had to deliver some bad news today to a young lady, because she's not going to be carried, their insurance carried, because of, medical challenges. So they're going to make sure that they can absolutely insure you, because they know that they can bring they're going to bring the money. They got the bag. So if you're trying to get the bag and you're trying to protect the bag, you want to protect the bag and an insurance, type product, like an index product. Okay. How does it differ from the annuity? Okay. Not 100%. If you go to if you're in some type of lawsuit, the courts is going to be able to see what you have with everything, right? But they cannot see what you have inside your policy. That's not something that's court visible. Okay. So your money is protected from the courts, rather it's carriers, it's divorce, it's whatever, it's protected. It's also protected from market volatility, as we just mentioned. Okay. You can have your money in the wrong type of annuity, and you could be susceptible to market volatility, just like you could if you had it in the wrong type of life insurance. Your money could be susceptible to market volatility. In other words, when the market go down, you can lose money. If you have your money in a variable universal life, you're going to lose money when the market lose money. You don't want it in that if you don't want to have that risk. If you want to take out the risk of losing money in the market, take out the risk of losing your money to any type of lawsuit, an index universal life policy is the number one way to go. All right. And you're going to be able to participate in the market when the market goes up. So let's think about the S&P 500, because the IUL parallels the performance of the of the S&P 500. Whatever the S&P 500 is doing, the IUL is going to parallel that performance. Okay. It is not taking your money and putting your money in the market. People always ask that question. No, your money is just going to perform like the S&P 500. Okay. And a whole life policy is going to more like a stock market. Okay. Different. It's a different type of way that it models. Okay. So that's the thing that you want to know about the life insurance versus the annuity. The other thing about the life insurance is going in an index universal life, particularly, you're going to have chronic, critical, and terminal illness. In other words, heart attack, cancer, stroke, dementia, Alzheimer's, any type of long-term care needs that you have. You can access your death benefit while you're living. So you don't have to worry about, this is a death. It's just a life insurance. It's not doing. Listen, we have policies, insurance carriers that have been doing upwards of 11 to 27%. Past results do not equal future results. There are no guarantees, but they typically do double digits. That's why people put their money in that's why corporations, billionaires put their money in an IUL, because they know that it's going to perform. It has in all of the 20-something years it's been around, and it's going to continue to do just that. Okay. That's why a lot of people still don't know about it, because it's not been around for as long as the whole life has been around. So when we talk about infinite banking and those types of concepts, people often talking about whole life, because most brokers know how to do whole life, but not every broker know how to do IULs. They don't know how to structure them. They don't know how to talk to them. They don't know how they perform. And they're just totally a different product, all in and by themselves. Like they have, if you was to go down the list of what are the benefits of an IUL versus a whole life versus everything else, the IUL is going to outpace everything in terms of benefits, right? So it's just important to understand that, because most people really don't know a lot about, what it is that the IUL can do. There is a book that I often put out, for people to see. My actual mentor that brought me into this business has written a book, and I just say her name is Shirley Liu. And if you follow me on Instagram, you've seen her talk about me and things of that nature. But she actually wrote this book, IUL, right? So IUL ASAP is the name of the book, and it talks about how to win the financial game of life. And it tells you all of the different things, about the IUL and how it's outpacing all of the different other types of financial vehicles. And so it talks about, potential market upside, like we talked about, when the market goes up, it goes up, right? And it also talks about the protection of your principal, how you're going to lock in your earning, how you're going to have, definitely you're going to have your tax-free income, like we talked about. So your money's going to grow tax-free. You're going to have tax-free access. You're going to have all those living benefits that we talked about. And I like this part, which is the versatility of the plan. So the versatility, because I have a truck driver client, and he had some challenges. He had his truck to go down, he couldn't get a load, and I had to go back and figure out what could he do different, because I didn't want him to lose his policy. And so what we found is that he can definitely pay the minimum and didn't have to pay what he had agreed to pay in the beginning. That's how flexible the IUL policy is. So in this case, this guy was going to actually, and he was paying like $711 a month, and he was going to end up forfeiting. He had already put in like almost $3,600. And I was like, we're not going to lose that money, and so definitely went and found out what can be your minimum. So instead of putting $711 a month, he could put in $395 a month. And he could skip a few months because he had already built up all his cash value. That's the difference between an IUL and other types of products out there. But as long as, because it's going to build cash value for you really high and really fast, right? And so that money that it builds up for you, now you can then take that money and now allow it to pay your premiums whenever you fall on hard times. Or you could take the money out, take out a loan, and oh, by the way, it's still compounding in your account even when it's in a loan status. Where else do they do that at? Like, first of all, you don't have to go to your creditors to try to get approved for your own loan. Hit on your credit report. It's your money that's been built in there, 5 figures, 6 figures. You can go in and see, this is what real estate investors are doing. They're taking these IULs, they're growing their money in them, and then they're taking that money and they're buying properties, they're flipping properties, they put the money back. Why? Because it's not going to have a tax implication on the money that grows inside of it. And they're just stuffing as much as they can up to the MECH limit that we often talk about. People are also doing annuities, letting their money grow really fast on an annuity. The money that the annuity makes for them, they take that money and then they leverage it and go get an IUL. So it's all different strategies that people are doing to make their money, make money for them and growth and, use it for other products. But, the fastest pace out there that I'm seeing, of course, in money that is risk-free is going to be an annuity. Okay. But you just don't get those benefits like the medical and in some cases, the courts could see your money, of course, and your annuity is not as protected. That's why people put those in trusts and things of that nature. All right. So what questions do we have out there, Brian, since we've been on here 27
You
minutes?
know what? It's not even a question, it's a statement. Junior Trooper 150. This is very informative. This is the type of video that should be getting more views. Salute to Shateka. And that's why, like, I challenge each and everybody that's out there that's listening to this program. You know what? Hit the like button, share. Share this with anybody that you love and care about that's in your contact on your telephone or even right now on your emails or your social media platform. Because once again, knowledge is power. So anytime right now is like I'm listening to the things that Shateka is speaking about, and it's huge because once again, like when you talk about investment is definitely tricky when you don't quite understand it. But what I like what she was saying is it's like almost like visualizing like your account is like a ship, and the difference is when it's a storm or when that it start getting wavy and everything start going down, like that ship might run into trouble because of the weather. But what happened is she's trying to tell you if you invest it right, you know what I'm saying, and basically with the index fund, it's like it doesn't matter what type of storm that ship or your account might be going through, you're not going to lose, you're going to maintain.
Right. And I just wanted to talk about that annuitize. I know I kept saying that word and I haven't really talked about it. Right. So when we talk about annuitize in an annuity, they're saying that when you turn on that income, that's for the rest of this is key. And if you're taking notes, you have to write this down. You have to understand this because you cannot go out here and get an annuity and it be annuitized and you don't understand what's happening. So please, annuitize means that when you turn on that income, and you say you're an annuitize, and this is key word. If you say you're going to annuitize the annuity, that means that the individual, the insured individual, when they die and that income stops, that stops everything. You don't want that to happen. So you do not want it to annuitize. And we have people that are frustrated because they are being sold an annuity and they are being annuitized. Because what you want is to not allow it to be annuitized. In other words, don't allow it to stop paying at the end of the person's life. If it says, if the contract says this income is to the end of the person's life, that is when it's annuitized. Okay. Now you want that money that's left over, because oftentimes there's a 5 and 6 figures left over, to go to the beneficiary. You know what I mean? And then we had a couple that said that they couldn't even get it to their children. They didn't even have it structured properly because they couldn't even go to the child. When the husband or the wife died, that was it. It wasn't even going to go to the child. So you want to make sure that, these things are structured properly when you speak to a broker, and that's really what you want to do. So annuitize is a word that's given the annuity a bad rap, and also not have in an index annuity is given annuity a bad rap. You want it in an index so it doesn't lose money, not just a regular annuity, because it can be, like I said before, it can lose money. And the reason why I'm saying this over and over, because people are daydreaming or their mind goes somewhere else and they say she didn't say that. So I have to please bear with me, because I know I sound like a broken record sometimes, but I want to make sure that the key points, I'm saying it over and over, because that's a key point. That means if I said it more than 2 times, you probably need to write that down. Because that's where people get frustrated and they don't know. And they go to these people and they get sold products, and then they frustrated and they come and they're like, oh my gosh, this horrible IUL, because it wasn't structured properly. They wasn't told that they had to properly fund it. They wasn't told how much they need to fund it. It's a lot of little details, and it's very sophisticated in how those things have to be structured. And if the broker don't know what they're doing, and you paying into this product and you don't understand the illustration, there's 2 types of the illustration is going to illustrate 2 ways. It's going to show you what the guaranteed is, and it's going to show you what the non-guaranteed. The non-guaranteed is most likely how it's going to perform, but we can't tell you that that's guaranteed. So, which is more than a guaranteed. In other words, if it says it's going to lapse at a certain age, guaranteed, that can happen if the market did horribly, and I mean like negative 0% every year for consecutively. So it's showing you what the guarantee is versus what the non-guarantee is. And all the time that we've been around, there's been nobody that's came and complained about their IUL. There's been nobody that says, oh, my IUL is not performing, it's not making money. Nobody said that. So, and it's not lapsed, because we're not going to help. Our goal is to make sure that we, first of all, don't sell an IUL to somebody that does not know it, that can't afford it. Let's just be clear. You do not have to be wealthy to have an IUL. That's a myth. You just have to fund it properly for whatever your death benefit amount is. So you can't get $1 million IUL and think you're going to pay $5,000 a year. That's not going to work. So you have to pay your premium proportionate to what the death benefit is. So we'll let you know what that number looks like, and we'll tell you that this is the minimum you need to pay, and this is the maximum that you can pay. The minimum is the minimum. The target is the target, which is what you tell us you can pay. Like this guy said, he can pay $711 a month. He fell on hard times. Okay, we come back, we reevaluate. Okay, you can't pay $711. You got to at least pay $395, and you got to at least pay that for the rest of the 20 years, and it's guaranteed that you can do this for 20 years. Because an IUL, what happens is, like any other insurance, as you get older, the cost of insurance goes up. That's the reason why you want to max fund those policies in the first few years. Let it make as much money. Like I pay my MECH. You want to pay your MECH limit, the maximum you can put inside your policy. They sent me a letter. It says, Shateka, don't put no more money in here because you're going to violate the TAMRA. There's a law that came out many years. You can look it up, TAMRA. You can't overstuff the policy. If you overstuff the policy, you can create a MECH.
What they gonna do? Spank that hand? No.
And they're gonna tax you. And once that policy is taxed, it's always gonna be taxed. But if it never gets taxed, your money will grow tax-free. This is one product you can put your money in and it grows tax-free. That's why people are flocking to the IUL. They don't want to have to pay taxes. Listen, if you go and you do any kind of investment out here, Bitcoin, Ripple, Ethereum, stocks, real estate, flipping cars, flipping this, flipping that, you're going to pay taxes. So you don't want to pay taxes on your growth of your money, then you need to put it inside an IUL. Point blank, bottom line. It's going to be one of the highest ways that you can grow your money without paying taxes. And that's why the wealthy use it. So they stuff it to the MAC limit. So if you're, when I say the MECH, that's the modified, it stands for modified endowment contract, meaning that is the most you could put inside this contract of an insurance policy, according to IRS code 7702. Okay. And if you do anything outside of that, if you take out too many withdrawals instead of loans, you can cause it a MECH. So you don't want to be taking a bunch of withdrawals. You want to take out loans. That's how do you get around paying the taxes. Now, I ain't trying to do no tax evasion around here now, but I'm just saying, that is going to cause a red flag if you do a whole lot of withdrawals. and your life insurance policy, and you don't take out a loan. You need to take out loans properly. You pay your 5% interest like you would in any type of loan, and know that your money is still compounding. If it's in an IUL, it will still compound. All right. And that's what you need to understand.
A quick question. Like, even right now, you got people out there listening. And to me, like right now, is a lot of times when you start hearing about these terminology like annuity and, the index funds and everything like that, is like the difference is right now, everybody feel like you have to have like an arm and a leg, like you have to have a ton of money to get started. And I think that's what a lot of people get like tricked at. And that's what a lot of people get discouraged at because they don't know and they don't even take the time to raise their hand and say, look, I don't know. What do I need to do? Like, I'm very interested in this and I need this for me and mine, but what proper step to make sure that I can do it and I can afford to do it?
I'm going to answer Mark's question in just a second. Yeah, I often tell people, listen, can you do $5 a day towards your future, towards the securing of your financial future? Can you take care of your older self today by putting away $5 a day? That's $150 a month. Some of y'all eat that in one meal. Some of y'all drink that in one meal. Some of y'all smoke that in one puff. So at the end of the day, $5 a day helps keeps the poverty away in retirement. And that's what we're talking about. So Mark, annuities is the way to go for who is the way to go for. You're not going to trap me. So what we want to make sure that we understand is that this is not financial advice. That what I'm giving you is just facts. That everything I'm telling you is facts, and that is it. And you can make an informed decision. I am a financial educator, financial planner, and I help educate you so you can make an informed decision. The fact is that if you put your money in an annuity and it's an index annuity, the fact is that you're not going to lose a penny. Okay? If you put your money in an index annuity and you make sure that you don't annuitize it, your family will get something when you expire. If you annuitize the annuity, they won't get a dime. So all the money that you have left in your plan, they won't get that because the contract says that it's until you die, it's until your death. You get an income until you die if you annuitize it. So I want you to be clear. Go back and look at your annuity. Find out if you have it annuitized or not, because they're not going to get anything if it's annuitized because your contract says until the end of your life. And you got to make sure that's okay. So annuity is for you if you're trying to grow your money and you want to look at the performance of the different types of funds that the annuity is placed inside of, right? And so what is the participation rate of that annuity? Is it 45%? Is it 100%? That's what you want to know, okay, when it comes to that annuity. The other thing is that does your annuity have a well-being rider on it or not? If you have terminal illness, can you use your money because you have a terminal illness? Or do you can't use anything? It's just gone. Will you be able to have a well-being rider? What kind of riders do you have in your annuity? If you can't use 2 of your activities of daily living, wash yourself, bathe yourself, walk around, talk, can you see, things of that nature. It's 6 of them. Okay. If you can't do those things, then 2 of those things, then you can actually double your income that you're getting from your annuity for 5 years, depending on what type of carrier it is. It might be less. It may not be, anything. You got to know every carrier has different. I'm talking to you as various products that are out there. I'm talking about different types of annuities that are out there. But there's a lot of different types of annuities, right? But the fixed index annuity is ideally the common annuity that people that know what they're doing and want to sell you something that's going to be beneficial, they're going to do a fixed index annuity. FIA, F-I-A, fixed index annuity. Going to give you the same, you're going to put the same amount of, you can put one money in. You might just do like one lump sum and let that grow. Or you can have where if you want to make payments, you can do a different type of annuity. It's still index. The goal is just to make sure that index is somewhere in that annuity name. Okay, because there's a lot of different types of annuities, but as long as index is in that annuity's name, it should be one where you don't lose a penny and you only can make money. Just like in the index universal life policy, you cannot lose a penny, but you can only make money. And so when you say is an annuity for you, the annuity is for you if you don't want to do an index universal life because you don't want to have a death benefit, you don't want to have the chronic, critical, and terminal illness and chronic injury component. You don't want to have protection from all lawsuits. Okay, that's what an index universal life come in at, right? So you get two types of protection more so than any type of annuity. Most annuities will help you. You will be able to see that the contract will not allow any type of court order, but you just want to be careful in terms of the carrier and how it's written, those types of things, if it's not inside of a trust. But it doesn't matter with an index universal life. That's not something that's visible by courts. That's why people like IULs.
You know what I like what you just got finished saying as far as like people do not understand health problem. It's gonna happen. Your body gonna start deteriorating. And I don't know, like within the last probably like 8 years, I've been trying to explain to people, man, if you don't have been making the right investment or you don't have no saving, you can't go to the bank and make a withdrawal if you never made a deposit. And the difference is what people got to understand is this. Nobody gonna wipe your behind for free. They can love you, they can do it for a little while, but after a while, trust me, nobody gonna wipe your behind for free. And so you talk about use that word property, and people do not understand that. And those are things like, look, man, as little as $5 a day. That's what you're trying to tell me. As little as $5 a day, $150 a week, a month. If I can able to start that now or more, then guess what? I don't have to worry about that situation, because once again, if I'm running into that situation, I can't take care of myself or whatever. Guess what? Somebody gonna, hey, I gotta, they gonna take care of you. If you don't got nothing, nothing for nothing, leave nothing.
Yeah, and just to add to what Mark's question was about, so annuities is the way to go. It's the way to go if you are looking at outpacing inflation. I've been talking about that a lot because inflation is at over 7% and then growing. So if your money is sitting in the bank, it is not outpacing inflation. So you want your money to outpace inflation in some type of financial vehicle, okay? Or else you're getting poorer and poorer. So if your money's just sitting in the bank, and I've talked to people all the time, 30,000, 50,000, they got sitting in the bank. Why? You're getting poorer and poorer. Do you not see that the inflation is 7% or more? So if you have your money inside of an annuity, if you look at especially 210%, depending on if you can get that type, my gosh, definitely outpacing inflation, right? So you're winning as long as you're, have your money in something that's going to outpace inflation. If you have your money inside of a whole life policy, that is not outpacing inflation. That is 3 to 5%, on average 4%. So it is not outpacing inflation. I'm just saying. So it is what it is. So great points. And now, listen, you need to stop.
Well, I'm being honest. You know what? Sometimes you got to, the difference is, you know what we do? We candy coat stuff. And in our society, we candy coat stuff. And something that you say right now is, guess what? A lot of times people go around talking about, I didn't know this, I didn't know that. The information that you give and what we talk about, I didn't know that. I didn't know this. So the difference right now is what you're doing is you giving me this information. So I'm being honest when I say nobody gonna wipe your ASS for free because they not.
Right. So you want to have your money. That the fact is that you want to have, the younger you are, the more time you have to play with your money and try to make it triple and quadruple and all this type of stuff. And you could take higher risk for higher rewards. You always have the higher the risk, the higher the reward. So the younger you are, your tolerance level is a little higher. The older you are, your tolerance is not as high. Because can you rebound from a loss at your age? That's a question you have to ask. We'll have enough time that if the market loses a lot of money and it tanks, will I be around when the market when it returns my money? How much longer am I going to have to wait for the market to return my money to me so that I can now be able to retire? If I put my money inside whatever type of account, whatever type of investment, can I afford to lose this money? Only put a portion of the money that you can afford to lose in those accounts. The portion that's for retirement needs to be in a more stable index type of account. And since we're talking about retiring before we expire, you want that turtle approach. where it might take a little bit longer than the average, but it's still going to get there. And that it's guaranteed it's going to get there, almost guaranteed. There is no guarantees, of course. We got to say that, disclaimer. Past results don't equal future results. But we've been seeing double digit on average for the average high performing IUL. They're doing double digits. So what else is going on? I'm not able to see.
Mark saying, what is the difference between 401k and investing in an annuity or profit sharing?
Okay, so a 401k is going to be a tax deferred product. So, I mean, that's basically what it is. So you're telling the government, I'm not making as much money right now. My money, so now you don't have to pay taxes on that right now, right? Later on, when you're ready to access the 401k funds, then you're going to have to pay taxes on it. So it's tax deferred. Okay. The profit sharing is just that. It's the government, it's their company. If they perform well, the company that you're working for, then they're going to give you, out of the abundance of what they made, some type of funding, right? So they're sharing their profit with their employees based on how they perform. Now, if you're asking 401k versus annuities, a 401k is tax deferred. You can start moving portions of your 401k into a Roth annuity, because your intent is to never have to pay taxes. Go ahead and pay the taxes now. Don't have to pay taxes when you're older, because if I was to ask you, do you feel like taxes are going to go up in the future? 99.999% of y'all will say yes, because you understand what's going on in the market. Okay. So the goal is to pay at the lowest tax versus the higher tax. Yes, you're going to have less taxes to pay because you may have less money being made when you're in retirement mode, but taxes are going to be, we feel like, significantly higher. Economists will tell you it's going to be higher based on what's going on right now. The highest has been in the history has been 94%. Now it's about 30%, right? A little over 30%. So the goal is to pay it at the lowest, tax possible. And so that's why people are starting to go ahead and dissolve their 401ks, paying, year by year, as much as they can pay, they can afford to pay, right? To the next tax bracket. They're paying the taxes now because they know the taxes are going to be higher in the future, and they're putting into the annuity, and ideally a Roth annuity. Okay. Once the money is put into an annuity, it's tax deferred, and then it becomes tax free at year 6. Okay. Tax deferred and then tax free at year 6. If it's inside, one of those types of annuities where you're trying to get it to become a Roth. If you're trying to put it into a Roth annuity, it has to be tax deferred for those 5 years first and let it season. So whatever portion you put in, that portion is tax deferred for 5 years. Then on the 6th year, it is tax free. If it's in a Roth annuity, then you might move another portion over the next year. That's what people are doing. Every year, they're just moving some of their money over from the 401k to the annuity so that they can move it into a tax free bucket so that they don't have to pay taxes later on. And they're getting that bonus because they moved it over into a rollover. So they're getting anywhere, like I said, between, on average, 7 to 10% is what they're getting on bonuses, depending on what state they're in.
T_Rivers asks, so how many taxes you want taken out of your retirement check?
None. Nobody wants to pay taxes in their older age.
Good answer.
But thank you, T Rivers. I've been meaning to get back with you because I want to share some more with you too. So how many? So yeah, it's up to the individual, but nobody wants to pay taxes in retirement. So retirement check, you're not going to be taxed on your Social Security, and you won't be taxed on anything that you put inside an IUL, and you won't be taxed on anything that you have in a Roth annuity or Roth IRA. So it's ideal to start moving your money into those types of accounts so that you don't have to pay taxes later on. All right. So any other questions out there? If not, we'll just continue to share these tips. But I wanted to make sure we understood what the differences were between an annuity and why people use annuities over insurance, because annuities are attractive to who is attractive to. If you can't get insurance, you can get an annuities, the next best thing in terms of looking for growth without loss to the market, and with an income that you're basically buying for the future. You're basically putting money away so that you can have an income in the future. You're designing your own pension plan, ideally, when you have an annuity or an IUL. And depending on which one will determine how much you will have in your pension, your personal pension plan that you've designed, based on whether you chose the IUL or you chose annuity or you chose both. Like I said, people are getting annuities, letting their money grow, and they're taking the money that's growing in the annuity and they're actually buying the IUL to have that death benefit, because what that annuity is not going to give you is that death benefit component that the IUL is going to give you. So you can put, I like to say insurance is wealth on sale. Like I told, if you looked at my stories a few weeks ago, I talked about this granddad who, he's putting $250 a month for his granddaughter. That she was born in September last year. By the time she's 58, she'll be a millionaire just off of the policy alone. Let's say she didn't do anything and she was horrible with her money. By the time she's 58 years old, she'll be a millionaire just by putting $250 in the account year over year, month over month, I should say. So it's a matter of understanding that, that's one thing, but her policy is going to be, it's going to have a death benefit of several $100,000s, right? But your annuity doesn't come with that death component. What happens is whatever money you don't use is going to be the beneficiary's benefit. It doesn't have that death benefit like the insurance is going to have. So that's the difference. Like you can literally purchase $1 million insurance. We like to talk about $1 million babies. People put monies on their baby so they can have $1 million policy on their baby. But you got to have that on you. You can't do $1 million policy on your baby and you don't have $1 million policy on yourself. The insurance going to look at you sideways. So you got to always have you got to have your policy in check before you can start putting it on the children. But that's another way that people build wealth. They're looking at their children not as liabilities, but as assets, as another opportunity to be able to stash money so that they don't have to pay taxes and they can have a death benefit on top of that. So, you talk about taxes, man. There's a lot of ways that you can leverage you and your entire family to be able to start these pension plans at a young age. You can listen, if he put more than $250 a month, just imagine how much faster she would be at a millionaire just off of a policy alone. He will only, at the age of 58, they will only have paid $174,000. That's why I like to say wealth on sale. $174,000 over the life of this young lady at the age of 58, because her grandfather was looking out for her and paid $250 a month and had paid $174,000 into that policy at the age of 58. She will be a millionaire, having $1 million. Then where else can you almost 10x your money? Wealth is on sale in an insurance policy. Don't believe the hype. You can't get this with a term policy. Okay, you're not gonna get it. So you get what you get out what you put in, right? So you start your children at a young age, and you set them up for success. People are putting, starting off smaller than that. That's fine. You don't have to put 250. That's great that he was able to do 250. Somebody might want to do $75 a month. You paying all this money on a lot of other junk that people do for children. When I say junk, it's not going to benefit them. They don't even, some of them, they're 1 year old. They don't even know that they have a toy. They're 1 year old. So why not start, something like that for them to start creating wealth? But yeah, this has been a great segment. So there's no other questions out there. We'll talk about some other different topics around wealth building. And some of this I know is going to be redundant for some of you that watch us regularly, but we just want to make sure we keep driving home these key points to everybody so that they understand. But definitely, if you need help with anything, I can certainly help you with annuity or life insurance product if you need help with that. So yeah, that's pretty much what we do.
So if anybody, like I said right now, it's like, to me, I'm online. I'm looking at this right now, and somebody just share this link with me. So if anybody, like I'm saying right now, is interested in the words that come out your mouth and want some advice or some help or point in the right direction, what do they need to do to contact you?
You definitely have it down there. Look like scrolling across the screen. So that'd be the best way. Shateka.com. You can go there to learn more about who I am, my background, all that good stuff, and just to see what I do. But I am a life insurance broker, and I'm in 14 and a half states because one of my states I got to do fingerprints, but I'm licensed in 14 and a half states and counting. So if a person is in a state and somebody on my team can help them, I have a team of individuals that are licensed around me. If I'm not licensed in the state, and then also I am actually a financial coach and retirement consultant, as you well know. So my goal is just to help people retire before they expire, because I understand that most people don't have their money positioned properly, especially government employees. Like we just helped this lady out and created, a huge income for her out of her TSP. And I had a TSP as an Army officer as well, so I get it. You don't know what you don't know. You get what the Army gives you. And she had a million two in her TSP, and so we were able to put half of it in an index annuity, and the other half we were able to create a generous income for her. So you can create your own income with money that you already have. That's going to not you're not going to outlive that money. That money's going to be there until you pass away. And if you have it properly structured, then it's going to be even for your family as the beneficiary. So how they can contact me, Shateka.com. That's ways you can do a consultation there, or you can I'm getting away from consultations for a lot of reasons. I'm doing group consultations for the most part. So my goal is to do group consultations, such as I'm doing webinars. So if you want to know when my next webinar is, you can definitely text BTFRA as he has it there, and then webinar, and I can add you to my webinar list as I'm doing my webinars. Just because I'm just one person and I can't do a whole lot of one-on-ones and for people to be indecisive. And I get it, because you got to understand what you don't understand. But I do have webinars that can play and let you see some of the information in a presentation form. And I have those available as well. So I can send you a link to send you to understand, a lot of this information. So if you go to Shateka.com, you can also see the business opportunity. We're looking at getting people that, are interested in doing this for their community and teaching their community. If you want to be a financial educator, I am looking for just one more inexperienced person to join my team, because I want to make sure that I can pour into people as much as I can, but I don't want to pour into anybody that's not going to show up. Like, if you know anything about me, I'm about the business. So if you're not ready to stand up and do what you say you're going to do, definitely don't want to work with me. But I'm definitely looking for people that are interested in helping their community, because our African American community primarily don't know this information. And I want to just make sure that we get it. There's a lot of different platforms out there that's helping to get the message out there, and that's great. But if you want to, have hands-on, experience with somebody that knows what they're doing and can actually, maybe shadow me with clients and how I do business, then and you want to learn this, then definitely let me know that the same way. Text BTFRA so I know that you came from the show, and you guys get preferential treatment. And girls, ladies, queens, and kings, you guys get preferential treatment when you do the BTFRA. So yeah, definitely want to make sure that we take care of you. And that's pretty much how you can contact me. So that 678 is a real number. It's a real number that you text me at, and I absolutely will get to you. Every now and then it's going to be somebody else, but most likely it's going to be me that's going to be responding to you. So
I got a couple of questions. The first question I got is 14.5 state. I'm confused about that 0.5.
yeah, I said because I have to get the fingerprints to a state.
Okay.
So it's like you can just pay for it, but if there's certain criteria you don't meet, like fingerprinting, that was the only piece for that particular state.
Okay. And Mark just came along. I'm the one I want to learn. Okay, that's good. So make sure you do what she say to do. www.shateka.com, or text BTFRA to 678-736-6496. Another
And if
thing,
you put agent behind BTFRA, that lets me know that you're interested in being an agent with me. Okay.
And another thing that I'm, like I said, I know it, but then again, for those that, probably just join us for the first time, it's like, here it is, you like that this ball of fire. Why are you so passionate about this?
Because our people, this we don't learn this in school, and I'm passionate about it because it's like I have this information people need to have, and I know it's not the how should I say it? It's not edutainment. It's not like exciting, sexy
Not
information.
that gangster stuff. No.
Yeah, I know it's not all that stuff.
Yeah.
And it's like, oh, it's when you say, listen, first of all, when you say insurance, people don't even want to hear about the insurance.
Mhm.
But when you start talking about all these benefits, like, listen, did you not know? And oh, by the way, you can get this, and this. Man, I'm just skimming the surface, literally, on what people can use these policies for and how they leverage these policies to build wealth. And we talked about it, the 6 components. We didn't even talk about the bank. We didn't talk about emergency funds and how, people are using this. We didn't really get into all of that. But it's so many reasons why people get permanent insurance, not term, because you can't do all of this with term. You can only do all this good stuff like the wealthy, the billionaires do with a permanent policy, rather it's whole life or an IUL. You can't do it with term because term is very limited. All it has is a death benefit. And guess what, guys and gals? It only pays out
If you die.
2% of the time. 98% of people are going to outlive a term policy and never ever use it. So it is a donation. Somebody type donation. It is a donation to this multi-billion dollar and trillion-dollar industry. It is a donation to the carrier. Okay. Term is a donation unless you use it. You have to die to use it. But if you have a permanent policy, you get all these benefits while you're living. It's not just a death benefit. You get to use it for cash. You can take out a loan. If you have medical challenges, 69% of bankruptcies are caused by what? Medical challenges. But if you have that, you can access your death benefit and accelerate the death benefit and use it while you're living to pay off those bills. And oh, by the way, if you don't pay your bills off, you can just pay yourself off. If you decide I don't want to pay my medical bills, it's yours. You just got to show that you got a medical challenge, chronic, critical, terminal illness, and you get access to your death benefit while you're living. Okay? Chronic injury, you get access to your death benefit while you're living. Okay? And oh, by the way, it's compounding and making money for you while you sleep because you don't know how to invest anyway. Buy term and invest the rest. You don't even know how to invest the rest. 99% of you don't know how to invest the rest. So why don't you just allow the people that know what they're doing, that billionaires trust, to invest the rest for you while you sleep? It's called sleep insurance for a reason, because rest assured, you can sleep at night because your money is not going to get lost in the market. When the market crashes and S&P 500 loses 1,000 points, you just turn over because your money is not going anywhere. It's still going to be with you. And that is why I get passionate, because if people know better, they will do better. They will stop putting their money in the wrong buckets, in the wrong types of investments. That's not making any money for them. That's not going to create any wealth for them, that they don't leave any legacy for, because they won't even be able to use it because they won't even die. They're going to outlive that type of. And listen, I get it. If that's what you can afford, guess what? I got all 3 different types. I got a term policy. I got a whole life policy. I got an index universal life policy. They all serve a different purpose. Term policy is for leverage. It is still wealth on sale. Just understand that, unless I outlive 95, my particular term policy will not run out. But most terms are only 30 years these days. They're not the old type of term. Okay. So you got to make sure, because the average term is going to expire in 30. I always tell people, if you're going to get term, make sure it does 2 things. It's going to give you a return on your premium, and or it's convertible to a permanent policy, because now you can afford to pay the permanent policy amount because you get more for your money. You get what you pay for. It's going to be more expensive, but you get all this benefits that you're buying for yourself. You're basically designing your own pension plan with your policy. You can't do that with a term policy, the average term policy, unless it has those 2 components. You can at least have, like I said, the return on premium. In other words, if you live and your policy is 25 years old, you get 65 to 100% of your money back, depending on what carrier you're with. But if you have to get a term policy, there's a policy that a carrier out there that's beating every term policy out there that we do business with. as a broker. And I don't care if you were an employer, they beat every employer plan, they're beating them. So if you have to have term, no shade, like they say, no problem. But I just want you to understand you're limiting yourself. If you can do better, do better, right? But especially if you have the new type of term, it's only going to last you about 30 years. You're going to outlive that on average. Every time the term renews, it's higher. It's more expensive. You got to take another exam. You got to all this. So be done with that. Get your permanent policy at the youngest age possible, at the healthiest your body is, so your premiums can be the lowest. Okay, people wait. Their body is all out of shape and everything is inside those medical records. I don't care what you tell them. They can look at the APS and see exactly what's going on with your body, and they can tell you no. Like they told this lady today, no. So you want to make sure you get it at the healthiest and youngest age possible. Every birthday, your premium is getting more and more expensive. Every birthday.
You know, another thing I was just thinking about is this. It's like even right now, as you explain and break it down to us in regards to the important insurance period, whereas sometimes you see like some of these celebrities, famous people that all of a sudden when they die, their family got to do a GoFundMe. Like that's like I'm confused. Like how in the heck? See, that's what I'm saying. Like how do you prevent that? And to me, like you here giving us this information now, and I'm thinking that's kind of whack. Like, oh, wait a minute, this guy was a celebrity. This young lady was a superstar. Why they got to start a GoFundMe to bury them?
Well, somebody didn't educate them properly, but all the funds, they didn't have a wealth team, and you want to have a wealth team, and a wealth team consists of a life insurance broker. No plug, but I'm a life insurance broker. A wealth team consists of a CPA or some type of tax professional, right? A wealth team consists of an estate planning attorney that's reputable and know exactly what to do in terms of how to do a lot of different things that I'm not going to talk a whole lot about, just because, yeah. But an estate planning attorney, a CPA, a life insurance broker, are the top, or like the three that you either need to have in your life, in your wealth team. If you're trying to build wealth, you need to have those people because they can help you, okay, with your wealth building ability. But this person didn't have the right people, unfortunately, with them, and so they wasn't informed. You know, they're doing final expense and all this kind of stuff too to at least cover the burial, but they're paying like 5 times the amount they need to pay. Listen, if you pay for your burial, I know it seems morbid, but if you pay for your burial while you're living or ahead of time, it's 50% less. You wait till you're expired, it's going to eat up everything from your final expense, and the final expense is going to take shots. It's going to be $10,000 for $40,000. No, you're going to pay $40,000 for a $10,000 final expense as a couple. That is ridiculous. Because first of all, the funeral is not going to be $10,000. It's going to be more like $20,000, and you paying $40,000 over your life for it. So why would you pay? Listen, because you paid for it your whole life, so you end up paying 2 people on average, a husband and wife, going to pay $40,000 for a $10,000 final expense to be able to bury themselves. Why? They're not doing our community right. You see what I'm saying? So you got to make sure that people can educate you on what it is that. Look at the number. Just look at the numbers when you go to final expense and all the years you got to pay for this thing. If you get, especially if you're getting it young, and you're and listen, funerals are there. The needle already moved. It's no longer 15,000. It's 25,000, and you still paying for a $10,000 policy. Are you kidding me? So you want to make sure that you understand. First of all, if you can pay it in advance. If you can't, no worries. Just make sure that your life insurance policy can cover it and not be a small final expense policy, because those are horrible for the most part. They're not good either. They're like not good. So the numbers, when you look at the numbers. So.
All right. Thank you.
But yeah, these are some good questions. I am from North Charleston. How'd you know Roy Williams? Do you know me? Did you go to school with me? That's crazy. North Charleston. That's where I'm from. Okay. Sidebar. Any other questions? I'm trying to see if I see any. They leave checks. That's right. Hi, Janine. I see you. I'm glad it's opening up the eyes. I mean, it's opened up my eyes. And so, yeah, you actually why I get excited. I get excited because I know a little something about finances that I didn't know when, I was growing up. And I didn't know even when I was making all this money in my 20s, 30s. I didn't know, how to do money. I didn't know how money worked. And when I look at the 6 steps of financial freedom, all 6 steps, a common denominator is a life insurance policy. I don't listen. If you look at all 6 steps, it's not going to be real estate. It's not going to be stocks. It's not going to be Bitcoin. It's not going to be all those things. It's going to be a life insurance policy. Number one, cash flow. Get your cash flow right. You can get it right with inside of a policy. Why? Because you going listen. You putting money in, you taking money out. That's cash flow. Where else can you do that at? And any of those other types, you have control of your money 100%. Okay, inside of that policy. Number 2 is an emergency fund. Emergency fund. Okay, that's why the wealthy don't have to go to these payday loans and get taken for their 50% interest, 100% interest on a loan. Are you kidding me? People are paying that because they don't have good credit. But if you go into your own emergency fund, because you're the bank, you own the money. And then number 3, debt. Every type of debt program out here, there's nothing that could beat that you having your money inside of a doggone policy, that money growing, making cash value for you, making it grow, making it do, making it rain. You taking that rain money and you go and go over here and you pay off the debt. Why? Because you have a plan. Because guess what? You can pay off all your debt in 7 to 9 years in a policy. It can be structured that way. So people that talk about debt and how you can pay off all your debt within 7 to 9 years, 9 times out of 10 they talk about a policy. When you go down, you drill down, you start having a conversation with them, they could come up with a policy because that's how people are doing it. They're structuring it in a policy. So that's 3 things I've already given you. 6 steps to financial freedom: cash flow, emergency fund, debt payoff. Okay, preservation of your wealth. How do you preserve your wealth? How do you protect your money? What else? What other tools out here are you going to put your money in that's going to protect it? That's going to keep you from losing the money that you've been making. Preservation of your wealth. Building wealth. Number 5. Building wealth. How are you going to build your wealth? That's what people are not doing, and all these other things because they keep. But somebody was just telling me this the other day. Every time I take 2 steps forward, I take 2 steps back. They talk about that. And that's the same thing that's what everything. That's what investing. You take 2 steps forward and 3 steps back. Why? Because you know what you're doing. But the insurance carriers, they know exactly what they're doing. So that's the reason why that's already 5 steps that you have, right? To building your wealth. And so people need to understand what are those steps, and then how the insurance can do that for them, where a lot of other items are not going to do that for them, right? And then I've already given you all 6. So cash flow, emergency fund, debt management, proper protection, building your wealth, preserving your wealth. Those are the 6 steps. And those are all done inside of a policy. They cannot all be done in any other type of financial vehicle. Look at every other financial vehicle out there, and all 6 of these steps cannot be done in anything else. And if you can find out how all 6 of these steps can be done in anything else, I'm going to take you to dinner myself. And I know it can't. So that's the reason why I'm telling you that if you trying to get financially free, this is a buzzword now. Everybody, financial freedom. I want financial independence, financial freedom, financial. But it's 6 steps. And I just gave you what those 6 steps are. So earning additional income with your cash value, your cash flow, managing your expenses, all that stuff can be done inside of a policy, literally. I'm not going to teach another whole class because we did this already. We talked about the 6 steps. Go back and look at Brian's our last, 3 or 4 times ago, but we talked about the 6 steps. So I'm not going to go over all of them, but you can go back and watch that replay. Definitely, you can share this out. You definitely can follow us. We're here most Wednesdays at 8 p.m., right? If I'm not traveling, because I do a lot of traveling. I was traveling this week, so it's my fault again. I was in Atlanta. But we want to make sure that we are definitely here to help, you win in wealth any way that we can. We are going to continue to bring these types of topics. So bring your questions and everything, and we're going to definitely answer them. We just kind of like skimming over it a little bit, but you know, every Monday morning I'm actually talking about, you know, the 99 retirement tips. I'm going to be on wisdom too on some of these Monday mornings, but I have 99 retirement tips that I talk about, and we're on tip number 16 on that. So definitely, you know, if you want to link to that, definitely link up with me so we can make sure that you get that information so you can be a part of that conversation as well. But if not, if there's no other comments or questions, I am done speaking for tonight. This has been a great segment. I'm always excited to talk about, you know, how to win in wealth, how to build wealth. And we already know what tools we're talking about when we talk about building wealth. The tax-free retirement account. That is the number one thing that people are using today to be able to move from spending a lot of money on taxes and not being able to keep their money and the money getting away from them. And unfortunately, they don't get to retire 100%. They have to go back to work in their 70s.
So thank you. And what I love more so than anything, you've given us every reason to take the excuses away. You know, it shouldn't be no excuse. You know, right now was because, once again, as long as we got 2 ears and 1 mouth, sometimes we got to listen and take notes. So once again, everybody, thank y'all for joining me for this segment. We truly, truly appreciate it. Roya McMorris just turning in. Thank you. And like I said right
You're
now,
welcome, Janine.
and everybody, like I say, tune in next week. We'll let you know when, whether it's going to be Wednesday, Thursday, but it will be next week, you know. And I like the way you do it on Clubhouse. If there's nothing else to say, you know, I'm gonna go ahead, you know, bye. I like that's kind of slick.
I count it down, get out of there, right?
I gotta steal that from you.
Yes. Yeah, I have a procedure next week, so God's willing, I'll be here next Wednesday.
Okay.
At 8 p.m.
We're gonna be praying for the sister. Yeah, look, we're gonna be praying for this. You're gonna be here. You're gonna be here, baby girl. You're gonna be here.
I'll be here at 8 o'clock next Wednesday.
Okay, 8 o'clock next Wednesday. Everybody, thank y'all for joining in. Y'all have yourself a great, tremendous Thursday. Peace, love, and prosperity.
You're welcome, Janine.